So hello everyone, and I do hope everyone is doing well in these crazy times. I am swamped with 200 students, endless emails and videos, and okay, so we're up to chapter 13. We're going to do chapter 13, and chapter 13 is basically non-bank finances. So we're going to look how institutions that basically engage in non-bank finance operate and how they're regulated. So we're going to talk about insurance companies, and we're going to talk about basically how insurance management, and we're going to talk about pension funds, and we're going to talk about private pensions and public pension plans. And there's a nice thing in your book on page 303 about should Social Security be privatized. And then we're going to talk about finance companies and then security market operations with investment banks and basically brokers and dealers and organized exchanges. And then we move into mutual funds and money market mutual funds. And then we talk about hedge funds. And then we talk about private equity and venture capital funds, or angel investors and venture capital. And basically, we finish up with government financial intermediation and, government credit agencies. So that'll be it for chapter 13. And there's a really, really nice thing on page 312 here about the global financial crisis and how the Fannie Mae and Freddie Mac were bailed out. All right, so we're going to start with insurance companies here. All right, we're going to look at different insurance products. And we're going to basically summarize the distinction between defined benefit and defined contribution pension plans. Some of you may know what that means already. I make my 401k. That's a defined contribution because I'm making my contributions and the money gets invested. And defined benefit was when a lot of people had pension plans, but a lot of those are gone now. We don't see pension plans as much anymore. Okay, so that's basically something that we're not seeing anymore the way we used to. So for the most part, everybody's in 401ks. All right, we're going to talk about investment banks. And investment banks basically are the intermediaries between the public who buy shares of stock and the companies who sell them when they're doing an initial public offering. Right, and the securities has brokers and dealers, and these are all traded on organized exchanges, such as the New York Stock Exchange and Chicago exchanges, and even the mercantile exchanges who do derivatives. Okay, and we're going to describe the role and activities of mutual funds in financial intermediation, which means they're like go-betweens, right? So we can just go to them and they are the intermediaries. We don't have to buy stocks directly. All right, and then we're going to look at hedge funds and mutual funds and why they're different. And we're going to define private equity and venture capital and summarize the different advantages as investment funds and look at the different types of government financial intermediation. All right, so first of all, we're going to talk about life insurance, and there's two types. There's permanent, right? And permanent's subdivided into whole, universal, and variable. And then there's term. And then we're going to talk about property and casualty insurance. Okay? So, but basically, insurance providers are pretty much regulated by the states, and they acquire funds they basically sell by selling policies that pay out benefits to the policyholder if some kind of catastrophic, life event occurs, property and casualty insurance companies hold more liquid assets than life insurance companies because of greater uncertainty regarding the benefits they will have to pay out. So let's talk about the different principal types of life insurance. All right. So there's basically, as we said, two major types of life insurance: term and whole life, right? So you can see here's the term, and they describe whole life as one. This is the major one, okay? Whole life is sometimes basically called permanent life insurance, and it pretty much encompasses several subcategories, including traditional whole life, universal life, variable life, basically around the period of 2016, 4.3 million individual life insurance policies bought with term, and about 6.4 million were whole life. Okay, so life insurance products for groups are different than those that are sold to individuals. The information in these slides is going to help us look at the difference, okay? All right, so that's permanent, right? And let's look at what are some of the permanent types of life insurance. So we have whole or ordinary life here, and this is pretty much the most common type of permanent life insurance. So it basically offers a death benefit along with a savings account. If you pick this type of life insurance policy, you are agreeing to pay a certain amount in premiums on a regular basis for a specific death benefit. The savings element would grow based on dividends the company pays to you. Okay, so that's basically whole or ordinary life. So universal or adjustable life is this basically affords you more flexibility than whole life insurance. That's the universal here. You may be able to increase the death benefit if you pass a medical examination. They'll offer that to you. The savings vehicle called the cash value account generally earns a money market rate of interest. After money has accumulated in your account, you basically have the option of altering your premium payments, providing there's enough money in your account to cover the costs. So this could be a useful feature if your economic situation has suddenly changed. However, you would need to keep in mind that if you stop or reduce your premiums and the saving accumulation gets used up, the policy might lapse and your life insurance coverage will end. So you got to look into all these features when you're going to buy insurance, all right? The other one is a variable life, which is listed here, right? And this policy combines death protection with a savings account that you can invest in stocks, bonds, and money market mutual funds. So it's a combination. It's death protection and savings, right? So the value of your policy, it could grow more quickly, but you also have more risk. If your investments do not do well, your cash value and death benefit for the variable life may decrease. Some policies, however, will guarantee that your death benefit will not fall below a minimum level. So then there's the other one called the variable universal life, which is kind of a combination of these two. So if you purchase this type of policy, which is the combination, you get the feature of variable and universal life policies. You have the investment risks and rewards characteristic of variable life insurance, right? Coupled with the ability, you can adjust the premiums and death benefit. Okay, so that's how those works. Okay, all right, and basically, then we have term, right? And then we have term insurance here. And a term insurance comes in basically two basic varieties here, right? We're over here on term. Level term and decreasing term, okay? So these days, almost everyone is buying level term insurance. So the term level and decreasing refer to the death benefit amount during the term of the policy. So a level term policy pays the same benefit amount if death occurs at any point during the term, but a decreasing one doesn't. And there is many different types of level terms. You can get 5-year renewable, 10-year, 15-year, 20-year, 25 and 30-year, and do that. And so if a policy is renewable, a term policy is renewable, that means it continues in force for an additional term or terms up to a specified age, even if the health of your health or other factors would cause you to be rejected if you had applied for a new life insurance policy. Generally, the premium for the policy is based on the insured person's age and health at the start, and the premium remains the same level for the length of the term. So premiums for 5-year renewable term, for instance, can be level for 5 years, then to a new rate reflecting the new age of the insured, and so on for every 5 years. So some longer term policies will guarantee that the premium will not increase during the term. All right. Others don't make that guarantee, enabling the insurance company to raise the rate during the policy's term. So some term policies are convertible, right? That means you could the person who owns that policy, you have the right to change it into a permanent type of life insurance without additional evidence of insurability. So another couple of points I want to make about term life insurance is basically in most types of term insurance, including homeowners and even auto insurance, if you haven't had a claim under the policy, by the time it expires, you get no refund of the premium. So your premium brought the protection that you had but didn't need, and you received fair value. So some term life insurance consumers have been unhappy at this outcome. So some insurers have created term life with a return of premium feature. So the premiums for the insurance with this feature are often significantly higher than for policies without it. And they generally require that you keep the policy in force to its term, or else you forfeit the return of the premium benefit. However, some policies will return the base premium, but not the extra premium, and others will return both. So that's pretty much it for life insurance. As far as that goes. All right, so the next one here is property and casualty. Now, property and casualty companies, like for instance, State Farm, they have life insurance too, but they're also casualty, right? And Geico, like I have on my car, and they hold a lot more liquid assets than life insurance companies, right? And they're also what's known as a reinsurance company. So as I was saying, like let's say State Farm, and I think your book mentions even Allstate as the largest insurance companies for property and casualty. And you've probably heard of Warren Buffett, and he has a big insurance company there, right? Berkshire Hathaway, and they have another company that do reinsurance, right? They do reinsurance. Now, what is reinsurance? Reinsurance is if a company can't pay out on big claims, they will partner up with other insurance companies, and by partnering up, the other insurance company will help pay the claims, but they do get part of the profits from some of the premiums that come in. Okay, so I believe Berkshire Hathaway is a reinsurance company, and we can look those up and see what those are. So basically, this is property and casualty, okay? All right, so the insurance industry has come in under fire for quite a while, through other means, the banking industry has been breathing down their neck, okay? And the banking industry has provided their own form of insurance. So from this added competition from the banks, the insurance company themselves, such as AIG, right? AIG was one of the big ones. They've come up with the innovative products. One of them is called a credit default swap, such that if a company has a major default or a problem, AIG will pay them. Okay, what AIG didn't realize was all the games that were going on with mortgage-backed securities in 2008, and they decided to insure everyone, and then they had to pay out billions, and they didn't have the money when all the mortgage companies such as and Lehman Brothers and Bear Stearns started going under, and the banks, right? So AIG got held having to pay out billions and billions, and they didn't have the funds to do that. So here's a breakdown for the last 46 years by percentage of intermediary assets, financial intermediary assets. So life insurance was 15%, and property and casualty were 3.8%. And then there was pension funds. And here's public, state, and local government pension funds. So these are private and these are public pension funds. Here's finance companies. And here's stocks and bonds. And it's interesting to look at this, because what you'll notice as time went on, how things have changed. And if you look here, you'll notice life insurance kind of like was on the decline here, and I guess casualty insurance pretty much stayed flat. But private pension funds, they kind of went from 8.4, and then they went up to 16.9. Now they were on the decline here, okay. And there's been a slow increase in public pension funds, and finance companies have somewhat laid flat, but over the last 10-15 years have dropped off. And you'll notice the huge increase in stocks and bonds, and the slow increase in money markets here, which they've even fell off in 2016. But you can see the big jump in stocks and bonds from 70. This was the big mover. So here's the remaining part of that chart, and you'll notice here at one point in 1970, commercial banks and savings and loans and mutual savings banks were had a big percentage of total financial intermediary assets. But as time went on, they've decreased over the years, the last 46 years or so. And you can see even credit unions have remained flat. So that is an interesting chart here. And unfortunately, it's in your book here on page 295. They show this breakdown from your book. Okay, so this is on page 295 in your book. All right, so what's the insurance management becomes a real important thing here. And the purpose of insurance is to try to reduce moral hazard and adverse selection, which we talk about a lot in this course, right? You know, a lot of behind the scenes games that are going on, and bad loans being made within the bank, and the adverse selection of poor customers, right? And even within companies, there's a lot of moral hazard going on. So basically, insurance management pretty much involves the screening of customers, and charging risk-based premiums, and also charging also having restrictive provisions in contracts, and prevention of fraud, and cancellation of insurance, and there's deductibles involved, and then you've been through this when you buy car insurance, and your insurance gets canceled if you don't pay your premiums. Okay, and there'll always be limits on the amount of insurance that is paid out. So your book has good sections on each of these items here. So for instance, in your book, they have a nice simple example for screening. So when you apply for auto insurance, the first thing your insurance agent does is ask you questions about your driving record, your speeding tickets, your accidents, the type of car you're insuring, and certain personal matters, your age, your marital status. And if you're in the assigned pool, if you're young, you'll pay more, and if you're single, you'll pay more. And if you're applying for life insurance, you're going to get, the similar type of grilling. You're going to get screened, okay? And you may even need a medical evaluation, okay? All right, I'm gonna continue this on the second part, because this is getting large now, and I will pick up on this slide on the second part 2 of chapter 13 here.